They could revalue the statutory price from $42.22, which was the last time revalued in 1973. They could revalue it to 5,000, and that would put a floor on gold at 5,000, and gold would fly. And yeah, and so would all the other minerals.
I mean, it would be a way for the government to slow down the sale of US Treasury bonds by foreign governments, because if they put the price of gold, they put a floor under the price of gold at, let's say, 5 or 10,000 or 15,000, whatever they decide. It means that when foreign governments decide to divest of US Treasury bonds to buy gold, which is something which we can see is happening already to a small extent, they're going to get a lot less gold for their Treasury bond, therefore reducing the incentive to do it.
Yeah, so they'll just stay in treasuries. Yeah,
I mean,
that's
I really think the USA has literally no choice but to revalue gold to, and probably a higher figure than the current level, much higher.
The United States faces a critical monetary imperative to revalue the statutory price of gold, which has remained stagnant at $42.22 since 1973. By resetting this official floor to a significantly higher level, potentially $5,000, $10,000, or even $15,000, the government could effectively disincentivize foreign nations from dumping US Treasury bonds. If gold becomes exponentially more expensive in dollar terms, global central banks would receive far less metal for their debt holdings, making the liquidation of treasuries strictly for gold accumulation a losing proposition. This strategic revaluation would not only ignite a massive rally in precious metals, but also serve as a defensive firewall to stabilize the bond market against sovereign divestment. MarioInnecco, a financial analyst, and Clive Thompson, a retired wealth manager, argue that this drastic measure is becoming unavoidable to protect the dollar's role in the global financial system. They contend that without this adjustment, the incentive for foreign governments to trade paper debt for physical assets remains dangerously high, leaving the US with no choice but to act. Now, we present the clips from MarioInnecco and Clive Thompson's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
the Treasury is or the Fed, they could work together and say, we will make sure that the price of silver doesn't fall below 100. They could do like a kind of a yield curve control, but precious metals or raw minerals price control. And with gold, that would be the revaluation, right? They could revalue the statutory price from $42.22, which was the last time revalued in 1973. They could revalue it to 5,000, and that would put a floor on gold at 5,000, and gold would fly. And yeah, and so would all the other minerals.
I mean, it would be a way for the government to slow down the sale of US Treasury bonds by foreign governments, because if they put the price of gold, they put a floor under the price of gold at, let's say, 5 or 10,000 or 15,000, whatever they decide. It means that when foreign governments decide to divest of US Treasury bonds to buy gold, which is something which we can see is happening already to a small extent, they're going to get a lot less gold for their Treasury bond, therefore reducing the incentive to do it.
Yeah, so they'll just stay in treasuries. Yeah,
I mean,
that's
I really think the USA has literally no choice but to revalue gold to, and probably a higher figure than the current level, much higher.
how are the prices of gold and silver determined now if Comex and LBMA are empty? Well, I think more and more it's being determined in the Far East, in Shanghai and other places like Singapore, or by the like precious metals people who actually deal in real physical gold and silver. But I would say more in China, Singapore, yeah, and places like that.
Well, first of all, how is the price going to be determined on Comex? Well, if the silver levels run down, as looks likely, the price will be squeezed higher and higher and higher until those silver levels stop falling below zero. That's what would happen in theory, unless, of course, Comex the CME decides to intervene and call a trading halt and talk about cash settlement. But let's assume that force majeure does not happen. Then you get if you've got all 400 million ounces demanding delivery when there's only 100 million ounces out there, that price of silver is going to go higher and higher very, very rapidly until the supply meets the demand, and that would be at a much higher price. But the other thing, which I think, just while we're on the subject of Comex and so forth, we've got to watch out for, and I think this would be the biggest warning sign of all if it happens. If you see a suspension of creation of ETFs. So at the moment, when you buy an ETF, behind the scenes, the ETF provider is creating new units and buying physical silver, especially PSLV. They're taking the silver off the exchange and put it in private vaults, and the silver is physically there. However, if they can't lay their hands on that physical silver, they will have to suspend the creation of new units, which means quite possibly trading would be halted on the exchanges, because it will, the exchange traded fund, if they can't create units, it won't be reflecting the net asset value anymore.
Yeah, I saw a post by Just Dario on X, and he noted that when silver was going, like from 60 to like 120, there was massive buying of SLV, and they're taking delivery of the silver, like people like the bullion banks. So the amount of shares in the SLV actually went down as the price went up. But now he said that with silver having corrected, the amount of SLV shares is gone right back up. So it's going to be a lot harder for the bullion banks to buy the SLV and demand the physical, because they have to return that physical. They lease it, they lease it from the SLV. So I agree with you. If SLV stops trading, that means there's no silver out there, and it seems like a game of physical musical chairs, Clive. The bullion banks, they lease silver from the ETFs to deliver in the futures, and then they have to find it again. And one day, though, that's going to explode, I think, and it could be in March.
I mean, there is one silver trust in China where they have already suspended creation of new units. And the reason was that the demand for units in that fund exceeded what they could lay their hands on in physical silver. So they basically suspended creation. They said at one point on the secondary market, the units were trading at double the net asset value, and they had to suspend it. Not only they suspended the fund from trading, they also suspended the creation of new units because they couldn't create the units, which would have caused the net asset value to come back in line with the share price. But obviously the share price had reached a massive premium, like I think it was 100% or something they said at one point, above what the net asset value was, and that made no sense.
The United States may soon be forced to implement a radical monetary defense strategy by revaluing the statutory price of gold from its 1973 level of $42.22 to a floor of $5,000 or higher. This move would effectively serve as yield curve control for precious metals, designed to disincentivize foreign nations from liquidating US Treasury bonds. By making gold exponentially more expensive in dollar terms, the U.S. government could ensure that foreign central banks receive significantly less bullion for their debt holdings, thereby stabilizing the bond market against aggressive divestment. As Western exchanges run empty, pricing power is rapidly shifting to the Far East, specifically Shanghai and Singapore. A critical danger signal is now flashing: the potential suspension of ETF unit creation. If major funds cannot source physical metal to back new shares, trading could halt, mirroring recent events in China, where scarcity caused premiums to double. This scenario suggests a dangerous game of physical musical chairs is nearing its end, where bullion banks can no longer lease metal to cover delivery obligations. Let's get back to the interview.
Last year, actually, gold and silver went up a lot, but generally, in the past, when they have this 7 day holiday, Comex and LBMA, yeah, they can do whatever they want. But I'm not too sure because what's going to happen this time because it could backfire on Comex and LBMA because I've heard that a lot of people that usually use the Western markets to buy gold and silver, they're going to China to buy over there. So if China's closed, they could demand uh, physical delivery from Comex and LBMA. So it could backfire, I think, Clive.
Yeah, I mean the Chinese New Year. I'm not sure the dates, but I think it starts, if I'm not mistaken, next week, and I guess it lasts for about a week. So the Shanghai Gold and Silver Exchange will be closed during that week. So those people who've been enjoying, myself included, watching the difference between the Comex price and the Shanghai price will have nothing to compare for a whole week. We've got around 100 million ounces available on Comex, which is registered silver. That's silver which is ready to be delivered into maturing contracts. The amount of silver spoken for, if it's all called for in the March contract, is close to 400 million ounces. In other words, 4 times what's available to be delivered. Now, the question is, will a lot of that be called for delivery, or will it all get rolled to the next major month, which is May? The One of the things which makes it look like it might be called is what happened in the February contract. And don't forget, we're only about 6 days into February now, or 10 days into February. Literally all of the open contracts, 100%, have been called for delivery in the month of February, i.e., instead of the usual thing of maybe 5 or 10% being called for delivery, it actually went to 100%. So people are on Comex changing their behavior, and instead of rolling over their contracts, they're asking for delivery. At least that has been the pattern in February and for the few months before that.
January
So
as well,
what
right, Clive? It was a lot, and
it
they're
it
not
looks like it.
and they're not front months, which means they're not heavily traded months.
But March is the big one. March is the
Yeah,
really,
and
really big one.
here's the open interest, Clive, 76,000. It went down actually the last by 4,400.
Yeah,
So
so
we
it's
have to,
slightly below four. It's slightly below 4 million ounces.
yeah.
Not 4 million. Is it 4 million or 400 million? Multiply that
Well,
figure
by
by 5,000.
5,000. It's 360 million, 300. Yeah, it's
Yeah, it's
5,000.
360 or 380
And I
million.
think there's only about 100 million in the
Yeah,
registered
there was
inventory.
103 million as of 2 days ago
Yeah,
was available. In other words, there's nearly 4 times as much spoken for if those futures go to delivery. We've got about 19 or 20 days before the first delivery day of March. So that
yeah,
first delivery day comes on, I think, the 27th of February.
yeah, yeah.
So it'll get quite exciting to see what happens to that number of 76,000 contracts. Will it go right down to almost nothing? And if it does go to nothing, what's happening? Are people closing their positions, or are they rolling them into May? Or if it doesn't go to nothing, then the big question becomes, are they going to demand delivery at the end of February, beginning of March?
I
And if they
suspect
do,
that 76,000 number might even increase again. And I think they're going to stand for a lot of delivery of that because they did the same thing for January and February. And they weren't like big trading months. But as for default, the COMEX will never, well, they will not never technically default because in their rule book, they say that they can cash settle. But I think if they were to do that, it would hurt their reputation massively. And yes, there could be force majeure. I mean, maybe if there is a breakout of hostilities in the Persian Gulf vis-a-vis Iran, that could be a reason for force majeure or some kind of event like 9/11. They shut the markets for a week, I think, back then, if I remember well. So yeah,
Well, if the long end, the people who are the longs on those contracts demand delivery, it will literally squeeze the silver price higher and higher and higher until someone says that's enough, for my price, and they actually decide to sell into the market or deliver to the market to meet that demand. But we just don't know who is behind each side of the contract. We don't know who's shorted, and we can guess. But we don't know, and we don't know who's bought it. We can guess again. It might be the buyers, might be the people who've got no choice. They've got to have it, like the
Yeah.
manufacturers.
While the Comex is unlikely to technically default due to rulebook clauses that allow for cash settlement, invoking this option would destroy confidence in the exchange. The analysts suggest that a force majeure event, potentially triggered by geopolitical tensions in regions like the Persian Gulf, could be used as a pretext to halt markets, similar to the shutdowns following 9/11. However, if the long holders are industrial manufacturers who physically require silver for production, cash settlements are useless. This dynamic ensures that the price must rise until it incentivizes existing holders to sell into the market. The opacity of the market complicates this standoff, as it is unclear who holds the short positions or the desperate long contracts. If the buyers are indeed manufacturers with no choice but to secure physical inventory, the price squeeze will not be alleviated by financial engineering. This reality sets the stage for a volatile repricing event in which the physical demand for metal overwhelms the paper market's ability to suppress it. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.